Hi, I'm Professor Bei Dong from USF School of Accountancy. Today, we're going to cover some topics related with depreciation, impairments, and depletion. In this audio, we're going to talk something related with depletion. First of all, what is depletion? Depletion is an accounting concept widely used in natural resources industry, for example, mining and petroleum. This is a process that is very similar to depreciation. It is the process for allocating the cost of those natural resources over time. And we're going to use units of production method to calculate periodical depletion expenses. Secondly, how to calculate depletion expenses. When we calculate depletion expenses, we need to go through 3 steps. First of all, we're going to calculate depletion basis. This is also called a depreciable cost. Secondly, we're going to compute a unit depletion rate. Thirdly, we're going to compute depletion expenses based on the usage or extraction. In terms of how to calculate depletion basis, the depletion base is comprised of the following 4 costs. Number 1, acquisition cost. This is a historical acquisition cost of the purchase or leased property which we found in natural resources, potentially. Second one is the exploration cost. This is the cost of locating those natural resources. But most of the time, this part of cost actually will be, expensed when they occur during the exploration. The third one is a development cost. Development costs are those costs preparing this property for extraction. For example, you need to purchase tunnels, you need to purchase those wells, you need to put a lot of labor cost to develop this property. Number 4 is restoration cost. This is the cost restoring this property to its original status after you're done with all the extraction. The second step is to compute a unit depletion rate. Here's the formula. We're going to first use the depletion base we just calculated from the first step minus the estimated salvage value divided by the total estimated units available. We get this depletion cost per unit. In the last step, we can compute depletion expenses based on the usage or extraction. Basically, what we're going to do is to use this depletion cost per unit we just calculated in the last step times the number of units of those natural resources extracted in this period. Then we can get the depletion expenses of this period. Now, let's look at a very simple example here. ABC Drill Corporation extracts oil from a known piece of land. It incurs the following cost. First one is land purchase cost. This is what we call acquisition cost. Then they have this road construction, drill pad construction, drill fees. These 3 costs are called development cost. And also they have this restoration cost. The total cost is $650,000. This is our total depletion base. And they also estimate that the oil reserves are 650,000 barrels. Okay, this is the total number of units available. Okay, based on those information, the next step, we're going to calculate the depletion expenses. In addition, we know that in the first year, ABC extracted 400,000 barrels of oil from this piece of land. Question here is to calculate the depletion expenses of the first year. Now, we're going to go through those 3 steps together. In the first step, we know that the depletion base is $650,000. Second, we're going to calculate depletion rate per unit. We're going to use the depletion base, $650,000 minus salvage value. Here, salvage value is 0, divided by total units available. Estimated one, which is 650,000 barrels of oils. So we get this depletion rate is $1 per barrel. In the third step, we can calculate depletion expenses of the first year. That is $1 per barrel times the 400,000 barrels of the oil extracted in the first year. That gives us depletion expense of the first year is $400,000.